Hello world, welcome back to our channel. I'm your host Tommy, and every week we make videos about personal finance, investment strategies, and everything in between. If you'd like to get updates in written form, check out our bi-weekly newsletter where we share our opinions about current market trends, our portfolio update, as well as investment ideas on our watch list. Today, we're going to be discussing the financials of Tesla. First, we'll share our bullish and bearish thesis, we'll estimate the fair value of the stock based on certain assumptions, and finally, we'll conclude with our investment decision. Let's get started, shall we? Alright, so we'll be breaking down the outlook and financials of Tesla in three parts. So first, we'll be sharing our bullish and bearish thesis for the company. Next, we'll make certain assumptions about the kind of numbers that they're going to hit by 2030 and try to come up with an intrinsic value estimate. And lastly, we'll conclude with whether we think the stock is worth buying or not. Alright, let's start off with the bullish thesis. Suppose that the supply of materials such as copper, nickel, and lithium can grow in line with the demand for more EVs, then Tesla essentially doesn't have a bottleneck because they can ramp up production in their existing gigafactories. The second thing that can go well is if there are other revenue streams such as insurance, Cybertruck, or robo-taxis can help to maintain high margins. So according to Elon Musk, Tesla is expected to produce 20 million EVs by 2030. So I'll use that as my first assumption. And my second assumption is that their operating margin can maintain at their all-time high, which is 15%. So moving on to my bearish thesis for Tesla, I think that due to shortages in certain materials, the cost is going to increase, and that will also increase the cost of production for their EVs. And because there's more competition coming up in Europe and Asia, this will decrease their pricing power despite having a strong brand. So Elon Musk's predictions don't often happen on time. In my bearish case, I'm going to assume that by 2030 they're producing 10 million cars per year instead of 20, and their operating margin is closer to 10%, slightly above the industry average. Now let's take our bullish and bearish thesis, add some expectations in terms of rate of return, and try to come up with a fair value for the stock. Alright, so the first way I'm going to estimate the value of Tesla is through discounted cash flow. As of 2021, their cash from operations was 11.5 billion and their capital expenditure was 6.5 billion. So this gives them a free cash flow of around 5 billion, which we'll use in a moment. Next, we have to set expectations for their growth rate. Let's take the best case scenario where they are able to grow their free cash flow the same rate as their revenue growth. This means we take the growth rate of their revenue, which was 7 billion 5 years ago, and as of 2021, it's 53.8 billion. Alright, so now let's go to our whiteboard and set our assumptions. Alright, for our DCF valuation, let's assume that the current price of Tesla is exactly $1 trillion and that their free cash flow is 5.017 billion. The growth rate, we're going to take the revenue growth as our best case scenario. So 53.82 billion versus 5 years ago gives us a growth rate of over 50%. What this means for their free cash flow in 2030 is that we take the free cash flow currently and multiply it with the growth rate over 8 years, and that gives us a future free cash flow of 131.14 billion. So now recall that the price that we should be willing to pay is the future free cash flow over the expected yield. And for a company like Tesla, I'm going to set the expected rate of return to 15%. So 131.14 over 15% gives us a fair value of 874.26 billion. So what this means is that compared to $1 trillion, Tesla's price is currently 14.38% overvalued. Or in other words, I need the price to correct by at least 12.57% before it's worth buying. And that's with really optimistic assumptions that their growth rate can hit these numbers for the next 8 years. Something that very few companies, if any, at their scale has ever been able to accomplish. So using discounted cash flow, Tesla is way too expensive, even if we use the most bullish assumptions. The second way I'm going to value Tesla is through the number of EVs produced. So Elon Musk says that they are going to be producing 20 million EVs by 2030. So I'm just going to say, let's say exactly at 2030 they produce 20 million EVs, and that will be my baseline assumption. I'm also going to look at the shares outstanding. So they have been diluting shareholders in the past, over the past 5 years, and I'm going to discount the expected return based on this dilution rate. Alright, so now let's try to estimate the future value of Tesla based on the number of vehicles they can produce and sell. First assumption is that they can produce 20 million EVs per year, and let's say by 2030 the average sale price of a Tesla increases to 70,000. We also assume that they continue to issue out more shares at the rate that they are. So let's calculate their dilution rate. We take their current number of shares outstanding and divide it by the number of shares 5 years ago. This works out to a dilution rate of around 9%. Now there are two possible scenarios. I think in the best case, the operating margin will stay at their all-time high of 15%, and the market continues to be exuberant about the stock. So they value it at, let's say, 60 times earnings multiple. And let's say in the normal case scenario, the operating margins are closer to the industry average of 10%, and the market values them at 30 times price to earnings. Let's do the best case scenario first. So we take the number of cars sold to calculate the revenue. So 20 million multiplied by 70,000, that gives us sales of 1.4 trillion. Earnings is revenue multiplied by the margins, which is 15%, and that gives us 210 billion in earnings. So what would the price of the stock be in this scenario? It would be 210 multiplied by 60, which would be a $12.6 trillion company. And what this means in terms of rate of return would be 12.6 over their current market cap over 8 years, which gives us a return of 37% or 28% after dilution, which is fantastic. Now in the normal case scenario, revenue would be the same, but operating margins would be lower, so the earnings would be 1.4 trillion multiplied by 10%, so 140 billion in earnings, and the market would value them at 140 times 30, a $4.2 trillion company. And in terms of returns, that works out to be 19.6% or 10.6% after dilution. So this is only slightly better than the S&P 500, and I think the more likely scenario to play out. We hope you've enjoyed our analysis of Tesla's financials. For part 1, where we focus on their qualitative features, check out the link below and in the top right. If you'd like to hear more from us, subscribe to our channel to get notified every time we release new videos. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you found this helpful, share this with your friends and family. We'll see you in the next video.